Hello, everyone. This is going to be my DCF and three estate analysis walkthrough of Lennar as a part of the Student Managed Investment Fund pitch that we had. So, just a little bit of background. I am part of the Student Managed Investment Fund here at Fordham, specifically within the real estate sector. And every semester we have to pitch a new stock. And this one that we decided to pitch this year was Lennar, which is, the second biggest home builder in America. So when we're looking at Lennar, it's a very volatile stock, as you can see, based on the 52-week high and low. But we think that Lennar is, structurally undervalued, and we think that management's hitting on a lot of good cylinders with our investment theses are the asset light model, and then more of our macro theses is that, we are expecting a housing market rebound. So, financial summary, this is, our three-statement model. But I think it's more appropriate if we start with our revenue projections, and then a lot of things will start to make sense within the three-statement model. So really, home building has been an issue. It's been a declining segment for this year for Lennar. This was pitched in November, so they're expecting around a 4 to 5% decline in revenue this year. And the reason for that is because the first-time home buyer, which is the main party they cater to, has really been struggling. And why is that? Well, that's a combination of things. That's due to, you know, large unemployment rates in millennials and, recent college graduates, and just overall home inaffordability for these people. And home prices have really shot up, much faster than inflation in the recently. There's a structural undersupply, and that this weird dynamic of like high housing prices and high mortgage rates has really been tough for the first time home buyer. But we are expecting a structural rebound when mortgage rates steadily drop, hopefully, when yields drop as the Fed starts to, go into a cutting cycle. And we expect a modest rebound in 2026, and then, kind of a more structural rebound in 2027 for revenue. So you can see here that, we went through the sales growth, but, gross profit is really one of the more important metrics and margins for home builders. This is because, for most home builders, depreciation and SG&A are baked into cost of goods sold, not operating expenses. So which is atypical of a firm. So Lennar, and all home builders' gross margins are important. Lennar is typically traded around, mid to low 20s gross margins, and you can see in 2024 there and 2023 there were huge margin decreases. Why is that? Is because Lennar had to incentivize first-time home buyers, and they did that via mortgage buydowns. So they would buy off points off the customer's mortgage for them to incentivize them to buy the home. What does that do? That increased costs for Lennar, but that also decreases the average selling price of a home for Lennar. So it's almost this double whammy of lower revenue and lower profits. But we think that with easing restrictions on housing and mortgage rates, we think that more home buyers will be willing to buy and sellers willing to sell. And we think that some of this demand will come back, and gross margins will hopefully, conservatively, we're expecting it back to 21% by the end of our forecast period. EBITDA is not a huge metric, and then neither is CapEx or depreciation, not as important. So we go back to the financial summary, you can see that really main things to hit on are the SG&A and depreciation are baked into cost of goods sold, not operating expenses. So, and then we, have this flow down to net income. As you can see, net income is going to be hit for 25 and 26, and then start back a recovery back in 2027. Here are, balance sheet where liabilities and equity, match with assets, and then our very basic cash flow statement. So now going to, the weighted average cost of capital, which is huge importance in the discounted cash flow. You can see in our cost of debt, we're taking three methods. We're taking implied cost of debt via interest, just the cost of debt based on their remaining debt outstanding, and then the credit spread. So you can see that the debt via interest is a very interesting and kind of fluctuates compared to cost of debt and credit spread, but we're taking a weighted approach, and we get an after-tax cost of debt of 4.83%. But, debt only makes up around 11.5% of the capital structure. So the cost of equity is a much more important metric here. And I think the main thing to realize here with the WACC is we added a 6% company-specific risk premium to our cost of equity to get 12.6%. Why do we do this? Well, Lennar has a lot of issues that are not really in their control, right? Mortgage rates, overall housing and consumer sentiment, right? So as a result, home builders have been very, very cyclical historically. This also leads with commodity prices, lumber, and controlling that, and just labor issues as well. So, we see Lennar to, we think a 6% premium is more than appropriate to factor in for our discounted cash flow. So now going into the DCF, all of this is pretty simple and being able to get to unlevered free cash flow. I won't go through everything, but I think the main thing to hit on is, this changes in working capital. So if you come here, we can see that, um, working capital is really decreasing over time. And why is this? Because Lennar has really, and most home builders have, they hold lots of inventory, right? And Lennar has come out with this new asset light model. So a typical home builder holds their land and has lots of inventory on their balance sheet, for unfinished homes. But what Lennar is going to do, and management has, you know, kind of sought this out, is to get their inventory turnover ratio to 3 times. We think that's a little aggressive, and we have a conservative estimate of around 2 times at the end of our forecast period. But we think that Lennar is doing this because of one of our investment theses was their approach to their asset light model. So, like I said, most typical home builders hold land and a lot of inventory on their balance sheet, but Lennar has spun off a lot of that onto they spun off one of their segments called Millrose Properties, which is now its own individual public company. And Lennar is trying to almost deleverage their and de-escalate their balance sheet. So they're moving a lot of their land obligations and inventory obligations onto this land bank of Millrose Properties, which should hopefully, boost multiples as a result, which I'll get to later. So that's an important thing to recognize when we look at this DCF, which is driving a lot of the free cash flow early on. EV/EBITDA is not a great multiple for home builders. We could have used a different multiple, but we didn't feel like it was appropriate. So we made it 75, 25%, perpetuity growth 75, DCF, EBITDA multiple 25%. And, we can see here that we're still looking at a 69, 70% premium and on the base case. And even if you look at the downside case, very, very conservative assumptions, we're still, assuming almost a 30% premium looking at the DCF. So we think Lennar is inherently undervalued in that case. And then going to our comps analysis, we really see 3 main competitors for Lennar. The first one is D.R. Horton, which is the biggest home builder in America, whereas Lennar is the second biggest. Pulte Home is also another big home builder. But we really think the main competitor for our analysis and our investment thesis is NVR. NVR is a home builder, a little smaller, but in 2000, around 2000, 2001, they were the pioneer that implemented this asset light model in which they spin off their assets into another entity. They almost become deleveraged, and they used they use options to buy their land instead of owning it outright. And as you can see here, down here, NVR trades at premium multiples, especially price to book compared to competitors and Lennar specifically. So when we come to our base and downside case, we're assuming that Lennar, should be worth and starts to become worth more towards NVR's multiple. So as you can see, our PE multiple, we use a 75% bias towards NVR. Same with our EV/EBITDA. Price to book value, we split as an average. But it shows, and then our downside case, we're showing, does the market not consider a multiple increase for Lennar? If that's the case, these are our assumptions. You can see price to book value doesn't change much, PE multiple doesn't change much, neither does EV/EBITDA, because that's the downside, is that the market does not factor in Lennar's asset light model and does not trade up compared closer to NVR. So really just showing a summary. I mean, you can see our downside case here, still a 16% premium with really, really conservative assumptions, which just shows that we think Lennar is extremely undervalued and just structurally undervalued. And we think there's a large margin of safety here for investors. And this is why we ultimately pitched it to the fund, and it got added into the fund. So, looking at a downside weight of 35%, which is pretty conservative, we're still expecting almost a 50% premium on Lennar. So this is my analysis and three statement model, and I hope you enjoyed and saw my insight on Lennar. And thank you very much for listening.